We're half an hour from the open in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Avril Hong in Singapore.
And I'm David Ingles here in Hong Kong. Let's get to your top stories this Monday. Shares across the Asia-Pacific edging slightly to the upside here. A cautious start to the week as investors await progress in U.S. trade negotiations with the region and really hopes of further stimulus coming out of the Chinese. Now, speaking of here, officials from the PBOC and other Chinese agencies are set to hold a briefing in the next hour. That's as the Politburo pledges to take emergency steps against external shocks. And fast fashion giant Shein hikes U.S. prices as much as 377%. That's ahead of tariffs and an early sign of the trade war's impact on consumers. Good Monday morning and welcome to the show. There are increasingly more signs of stability permeating across these markets, and as you can see, we're up about a 1%. Within the sort of equity complex, a couple of things to note very early this Monday. Of course, within the Nikkei and the Japanese market, there's this big deal, of course, and our reporting suggesting that Toyota might be looking to buyout Toyota Industries. That's number one. Number two is, of course, the Huawei story out of the journal. Really, that's why we're looking at some of the big tech-related shares. Taiwan, of course, is a case in point here, 0.7 to 1% to the upside. Apart from that, though, there's really not much to sink your teeth into at this point in time. Perhaps as we flip the page here and we look at the earnings seeds, and 130 companies are set to report thereabouts there on MSCI China today. Lots of earnings reaction from Friday. And I guess as you look at that as well, so BYD, of course, was the big one that came out on Friday. This is how shares traded on Friday. That's not what we're doing right now, but I guess it's an indication of what we might likely see going into the open today. Let's flip the boards, please, and have a look at how we're set up going into the Chinese open today. We're looking at steel in particular as well, given the pop that we had going into the weekend, and a further 1% to the upside right now. Now, when you look at dollar China, it's really been extremely range bound since about mid of last week. 100-day moving average is really where we have sort of consolidated around the pair. Now, all that being said, I think on the positive side of things, signs of a detente, if you will, exemptions here and there from both sides. Chips is also a good example of that. So we'll talk more about it in a moment. We are flat going into the Monday session here as well. So yeah, Avril, we're looking ahead to several things. The government briefings really front and center as well.
Yeah, whether we get any sense of perhaps jobs market support in a way, given how this is an employment sort of briefing. And as we know, youth unemployment, a big sticking point still in the country. But these chip stocks, as you highlighted the Huawei story earlier, is this another deep-seek moment, but this time potentially geared more towards the hardware side of things? So not just chip stocks, but really the entire AI complex and earnings. We have a couple of those quite consumer-facing companies that are due to report. So we got Tsingtao, we got SF Holdings, of course, Wuxi AppTech, another one that we're keeping a close watch on. And then on top of that, the pain point for China has really been the property sector, and the builder Sunak China is asking creditors for support for its debt plan. So there's a wind-up hearing. Will we get another adjournment of sorts? So those are among the things that we're watching today, David.
Yeah, and to really help us understand those two things, those two interconnected things, right? Markets, risk premium over U.S. assets, and of course, what the business environment looks like as far as the Chinese mainland goes, particularly for American companies. So we have two special guests coming through this hour. We have Michael Hart, of course, from the American Chamber of Commerce in China. They released this white paper over the weekend. We'll talk to him more about that. And really, is it this degree of stability that's set in to global markets? Can we trust the process? Salman Ahmed joins us out of Fidelity at those times on your screens. Right, now let's get more on this, a preview of what Chinese officials might say and do. This press briefing, this news conference set to take place in the next hour. So focusing on, as Avril was just pointing out there, measures to stabilize the employment situation, promote what they call high-quality development. It follows from Friday's Politburo meeting, which pledged to prepare emergency plans against external shocks. Let's bring in Min Lo, our China correspondent, to give us a preview of what we can and should expect from today's briefing.
Yes, so we have MOFCOM, NDRC, which is the economic planner, and the PBOC and the Ministry of Human Resources, who will be at the briefing today. So you can guess what the focus of this will be. So when it comes to developing the high-quality development, the focus is going to be on AI. That was the guidance from the Politburo meeting as well. So the PBOC, we want to look out for whether they would announce any low-cost financing facility, policy financing to support investments into key strategic sectors. Of course, the monetary policy, that was something PBOC Governor Pan Gongsheng said last Friday in Washington about how he would continue to loosen monetary policy and keep the exchange rate stable. When it comes to stabilizing employment, though, we know the Politburo had mentioned increasing unemployment payouts through this job stabilization fund, that it's in particular to support those companies that are particularly affected by the impact of tariffs. And when it comes to boosting growth, again, measures to boost the income of the lower and middle income household groups, relending facility for the elder care sector, for example. So if some of these measures sound a bit familiar, it's because the Politburo so far doesn't seem to be introducing new innovative policies. It seems like the focus is more about accelerating the implementation of policies that had already been approved in March, and could be because the first quarter GDP data came out pretty strong, 5.4%, and it looks like the government is comfortable to hold this wait-and-see stance as they assess how the second quarter of the economy goes post-Liberation Day.
Well, speaking of sounding familiar, again, President Trump appearing confident that they might be able to strike a deal. Well, what were the latest comments, and what can we make of that? Because we get one every day, really.
Yeah. Well, he is projecting confidence that China will be wanting to make a deal soon. He said it's going to be positive. He said that trade has fallen off because of the tariffs he has imposed, and at some point China will want a deal. And he reiterated that the U.S. is not going to offer unilateral lowering of the tariffs unless China offers something substantial in return. And when pressed about what that means, he says he wants China to open up its market further, although he said he's not going to ask for that in a trade deal because he thinks that China wouldn't be open to that. But in fact, China has consistently been sending this message that it is opening up its market. That's consistently across all state media and the statements from Chinese ministries that they are committed to opening up. And China has complained that they are not clear exactly on what the U.S. administration wants. It's been confusing, and they have demanded, at least according to sources, they've been wanting a point person to really oversee these talks. And it doesn't look like there is any progress on that front, even though Trump has said both sides are meeting. China has refuted that. So again, it's still really mixed signals here. But meantime, companies like Shein can't hold that wait-and-see approach because you have the de minimis rule that is being implemented starting from May. So many of these companies, Temu as well, they are already raising prices. So your hand towels, I was just checking on Shein, it used to cost $1.20, now it's $6 for a pack of 10, and a big price jump as much as 50% when it comes to beauty and healthcare products, about 30% when it comes to home and kitchen products.
Yeah, we're certainly seeing these signs of the consumer potentially being hurt by tariffs. What about some of these longer-term priorities for China? AI remains a focus. What sort of policy support is the government signaling?
Yes, this was across the front page of state media, including People's Daily yesterday. And this was something that President Xi mentioned in a study session with the Central Committee of the Chinese Communist Party. And it really focused on this long-term plan of boosting China's AI development and particularly helping China be independent when it comes to core technology, including these advanced chips as well as foundational software to overcome some of the challenges and the bottlenecks they face there, given the export restrictions from the US, and also urging for comprehensive policy support, whether it's in the form of IP rights protection, whether it's fiscal and tax policies when it comes to measures or rules that support new facilities opening and the like, and also urging for this global adoption of standards when it comes to the rules governing AI. The state media piece also mentioned how China must ensure that there is international collaboration, given that AI is a global public good, in particular with the global south, helping them to bridge that technological gap. So you can see that while that collaboration seems to be focused on collaborating with the global south, when it comes to the US, though, the focus is all about hedging that decoupling risk, ensuring their first mover advantage and the competitive advantage is being maintained.
Min, thank you so much. Min Lo, our China correspondent there. From one big story to another here, we woke up this morning in the Asia Pacific. This report out of the Journal today. Massive one on Huawei reportedly preparing to test a new AI processor that it hopes can replace some products made from Nvidia. We have that bottom of the screens coming through as well in terms of the headline, and also U.S. futures, NASDAQ futures in particular. And we'll see whether or not this is actually a sort of idiosyncratic reaction to that. We're down about 0.7% there currently. Let's bring in Mayumi Negishi, our tech editor, to talk us through what we know so far about this new technology. Mayumi, what do we know about this?
Well, we're still chasing this report. The Journal reported that Huawei is testing the feasibility of this new chip. It's they call it the Sen 910D, and sending samples to companies. I'd like to caution that this is a very common step in the design of any chip. You want to send samples, assess the performance, get feedback, and then go back to the design and make any necessary tweaks. And this typically happens a few times, and this is a very early stage. It does show that the Chinese chip and AI ecosystem remains robust and humming, and despite the U.S. export restrictions on technology. But that's a little different from the question of, well, now can Huawei really create an Nvidia killer? Can they create a rival to Nvidia? Can they manufacture the chips that they develop at scale and at yields that make it economically feasible? And that's sort of been the big hurdle for China so far because of these U.S. export restrictions. They don't have the equipment, or they haven't so far, to manufacture really bleeding-edge chips at scale. So what we've seen them doing so far is sort of mash together inferior chips and find ways to sort of in the back end processing to sort of make up for not being able to create the really powerful chips that they can't import. The problem with that approach is that, because you're mashing so many chip components together, that lowers the yield, that raises the error rate, and it also means that you need a lot more power to get the same kind of capabilities. So that's a real limitation when you're talking about developing AI at scale. You would need to build, and also to pack power inside AI into small gadgets, for instance. So these are kind of two separate issues: the development side and the manufacturing side. And if the Journal is right about this development, it still doesn't mean that China is right there,
right,
kind of breathing on Nvidia's heels.
It might just be one step in the process, par for the course. Mayumi, great to get your context and reporting for us on this. Bloomberg's tech editor, Mayumi Negishi, for us. Still to come this hour, Ukraine's president says he's hoping for results after what he called a good meeting with President Trump at the Vatican. The latest on the peace push a little later, and we're counting down to the open of trade in Shanghai, Shenzhen, and Hong Kong. This is The China Show.
Good morning and welcome back. You're watching the China Show. Your reference rate for today is out. So we're looking at 720.2043 against the U.S. dollar. The estimates are for 728.43. Not much movement across, not just the Chinese currency right now, really just across assets as we, I guess, begin the week on a fairly stable but also quite boring footing, which I think is a blessing given the April that we've had so far. Well, the night is young, as they say, and so is the week. Have a look at what we have in store for you this week. Elections, of course, coming through. Canada, Australia, and also in Singapore. You have President Trump's trade policies and the cost of living issues obviously hanging over all three economies here. This Monday, you have Canadian Prime Minister Mark Carney will be attempting to lead the Liberal Party to a fourth straight election win that looked impossible just, Avril, a few months back.
Yeah, and amid all this, the growth, inflation dynamics, we're going to be keeping a close watch on anything eco-data related, right? The U.S. economy expected to show weak growth in the first quarter, even before Trump's sweeping duties were announced on April 2nd. The job market expected to remain stable with a forecast 130,000 increase in payrolls. Closer to home here in Asia, Bloomberg Economics expects the Bank of Japan to stand pat on rates on Thursday, and policymakers in Thailand could deliver a 25 basis point cut. In China, also keeping a close watch on those official PMI numbers on Wednesday for the month of April. That data, mind you, will capture the impact of President Trump's tariffs, Dave.
Yeah, amidst this growing list of reductions to growth forecasts, not just in China, right, but you look just about across globally right now. So what is the appropriate exposure to risk across assets that is, I guess, best prescribed right now, given the outlook or the lack of it, the clarity there? Salman Ahmed is Global Head of Macro and Strategic Asset Allocation at Fidelity International. It's very nice to see it. Quite a timely conversation to really have you. Thank you for coming in. What do you make of this? What does your team make of this flow out of dollar assets?
Sure. Thank you for having me, David. So definitely, I think this is an important focus area for us. Firstly, we're doing a lot of work on who owns U.S. dollar assets and what are the incentives and their, pressure points, if you will. So let's, and obviously out of that, U.S. Treasury, I think ownership structure is quite interesting to us. Since the last few years, price-insensitive buyers' share in U.S. Treasury holdings have been coming down. And hedge fund and leverage players' role has been increasing. And this is not something which happened over the last few months. This has been a trend for the last few years. And a lot of, for example, BIS and even the Fed has been focused on this vulnerability to the treasury market. So I think looking forward, I think we have to focus on, what kind of players are involved and what are the incentives to hold U.S. Treasuries.
And how does it then inform us about whether the outflows continue? Because I think you make a good point. The process was already taking place even before Liberation Day.
Yeah, definitely. So I think the ownership. Let's think about the steady state, right? Medium term, in terms of where this lands up. So if we have a world which is fragmented, which is more deglobalized, then the financing of U.S. debt and deficit is not going to be as diversified as it was before, right? It was always linked with trade relationships. So in that sense, I think we do have to think about what replaces those price-insensitive buyers. Would that be the Fed, right, in some shape or form, or would be friendly countries, as Stephen Moran talks about? So I think there are some big questions hanging around. What is the steady-state model of financing of U.S. Treasuries?
We're also watching data of the U.S. this week. What is your sense of the recession as well as stagflation risk going forward?
So we have been in the camp of some combination of stagflation and recession being the core or baseline risk or scenario for 2025. We had that view going into Liberation Day as we were focused on the risk of in and out of tariffs. So soft data obviously is collapsing. Hard data, or at least the early indicators of hard data, are starting to show some interesting patterns. So, there have been a lot of focus on container shipments coming into the U.S. That that leads to, what happens to supply chains, inventories, but really the hard data shock, I think, lies ahead. And that's what we will be focused on, especially the labor market data, which comes up in the next few days, trying to understand, if soft data is overestimating or, over implying the weakness, or now this shock is in pipeline and we have to start thinking about real damage to the economy rather than thinking about it all the time at the moment, which is what we are doing at the moment.
It's really tricky. But what is your assessment of the US-China trade war, how it's evolving? Is this more between the two superpowers, or is this the global trade war that markets, economists have been more worried about?
I think both are interlinked in some ways. Obviously, as you mentioned, both are key economic powers. I think we should not forget about Europe here as well. They are, in the slightly in the background, but they are a key player here. And we would have to think about, what happens after those 90 days. And in Europe, it's not just economics; it's also about security. So both of those dimensions are interlinked. So ultimately, we have to think about, what is the steady state tariffs from the U.S. to the rest of the world? How does the rest of the world, especially China and Europe, cope with that? So there's a lot of uncertainty, and that makes obviously planning very, very difficult for businesses. And we are also likely to see impact on consumer as well. So quite a lot of uncertainty still in play, I would say.
Yeah, Salman, you hit the nail on the head there. More with Salman Ahmed coming through here, Global Head of Macro and Strategic Asset Allocation of Fidelity. It's been difficult to plan. Businesses, asset allocators, even us here in news, it's almost like an exercise that is not willing to be undertook, given how things have been changing. Right, going into the open today, 0.4%, 22,000 on the Hang Seng Index. The PBOC just injecting 103 billion renminbi into the system open market operations. The exchange rate is what, 720? So that's about a $14 billion injection today. I'm just doing some rough math in my head. Given the exchange rate, plenty more ahead. This is the China Show. Happy Monday morning. Right, welcome back. We're looking at a higher open slightly. And we're also in the thick of earnings season. About 130 or so companies on MSCI China set to report today. You had really, really big liquor makers report on Friday. You had BYD, plus some other big car makers to get into as far as market reaction goes, Avril, going into the session today.
Yeah, I think for BYD, our analysts have already pointed out that maybe watch out more for the pricing strategy. That's more important to keep an eye on versus this first quarter being seen as more of a neutral sort of guidance that's coming through. Keep an eye as well on Great Wall Motor. I think it's been downgraded to hold by Yuan Securities, but we're seeing in the pre-market looking quite weak.
Welcome back. You're watching the China Show, just counting down to the open of markets here in the greater China complex. Lots to talk about. In Japan, I'll just make it very quick. Toyota Industries set to surge, of course, on the back of that report that Toyota is looking to buy out. Of course, within the Chinese space, you have tourism-related stocks on the back of, I think, news on higher allowances for duty-free for foreigners. And on top of that, this nuclear power story that's coming out too. And of course, we talked about earnings a lot too here, Avril.
Yeah, I think based on what futures are telling us is quite interesting. Maybe markets are adopting more of a wait-and-see approach. We'll believe it when we see it when it comes to the US-China de-escalation, when it comes to Huawei potentially delivering a sort of chip that can rival the likes of Nvidia. So we're seeing it quite flat actually still this Monday morning. The early goings and trades, CSI 300 looking quite flat, and this is despite that lift that we saw in markets in the afternoon session on Friday following talk about that potential exemption for U.S. goods in terms of China and tariffs, keeping an eye on some of the other sectors as well, moving sideways more or less. Let's flip the board and take a look at how Hong Kong is shaping up in the early goings, because again, it was quite a positive day by the end of the session today. Again, moving sideways, keeping an eye as well on some of the chip-related stocks, including SMIC, everything going when it comes to the Huawei headlines that we've been getting. But keep in mind as well, the employment briefing is going to be one to watch. We also have some of these positive AI policy support measures potentially. That's based on state media and what the Chinese president is thinking. Flip the board again. As we keep a close watch on those Huawei developments, we're going to be watching not just some of these chip-related names, Huawei suppliers, but the entire AI ecosystem as well. David.
Yeah. Okay. Lots to sink our teeth into, and perhaps we might actually even get more as we get more earnings coming through this week, right? So let's take a step back here, half a step back, not too much. So what we've seen so far is we've seen economists come through and come out with their latest revisions in growth, which, as expected, have been mostly lower, not across the board, but they've taken projections down for China, right? What are we seeing as far as earnings go? These are 12-month projections, MSCI China, that's consensus, and as you can see, it's really been largely undisturbed. Green circle is DeepSeek, red circle is Liberation Day, big dip there, but as you can see, we've stabilized right now. What is the earnings season looking like, and what's the guidance been looking like? Let's bring in Charlotte Yang, our Asia equities reporter, to just help us understand really what we're hearing so far, what we've seen so far from Chinese corporates.
Yeah, so I think for today, we're watching a lot of the reactions from the Friday results. So we have on the auto sector, you have BYD, which the earnings, because they had the preliminary guidance, so the results are largely in line with what they have guided. But what investors really watching is whether there will be more signs of price cuts, given that this quarter is traditionally a low sales season, and there has been some delayed models because of the Shanghai Auto Show. And also we have Great Wall, which saw a sharp decline in profit for the first quarter, but that's really due to a one-off deferral of some Russia tax rebate. So the second quarter could be better. And also, on the insurance sector, we have Ping An, whose profit also declined quite steeply because of the investment returns. And so it's a lot of the key companies, the different sectors we're watching today for the reactions.
What about for the rest of this week? What are you watching out for in terms of how sensitive to tariffs and how that's showing up in the outlook for companies the whole of this week that are reporting earnings?
Yeah, so I think JP Morgan said this week is, I think, is the busiest for the Hong Kong listed companies. So I think they calculated that 17 companies listed in Hong Kong will report, and that's about, I think, around 40% market cap for Hang Seng Index and Hang Seng and China Enterprise Indexes. And so for today, we're expecting results coming later today for Qingdao Brewery, which is this big, beer producer, and the investors will be watching for the signals of consumption recovery. And also we have SF Holdings, the delivery couriers that's reporting, as well as Wuxi AppTech, and investors were watching, how the pressure coming from the U.S. on the U.S. trade side. And for tomorrow, it's a big China Banks Day, and so there has been concerns with, how their profitability has been, holding up because of the property sector struggling and also the economy. So the big banks will be a key thing to watch.
There we go, Charlotte. Thank you so much. Charlotte Yang, our Asia equities reporter here. Right, just on the earnings story, right? Just a couple of big names to watch this week throughout the Asia Pacific here. So we talked about the Chinese banks, so set to report, of course, Tuesday, at least the start of it. Now, speaking of banks, HSBC, Stanchart are also in deck, and then that takes us into sort of the consumer-facing names. Not really Tokyo Electron, that's a B2B name, but Samsung, of course, is a big one to watch, and certainly the guidance coming through there out of the companies as we look ahead to the level of uncertainty that exists currently across these markets in the global economy. Still with us here for some final thoughts is Salman Ahmed, Global Head of Macro and Strategic Asset Allocation at Fidelity International. I like what you said, you told me during the break, you make your investment decisions in terms of geographic preferences of those places that are not in the news.
Exactly. I think not being in the news is a good thing right now. Yeah. And I think, I think if you take that principle forward, so LATAM, for example, if you think about LATAM countries, commodity rich, they can play all these three, potential blocks which may appear, like China, Europe, US, and they have something to offer to these major economic powers. And then UK as well, I would argue, because UK is less exposed to tariff risk. Obviously, they're trying to work out a deal as well. But if you look at the makeup of FTSE 100, stable, high cash flow companies, low valuations, and not much in the news. So if you do, a cloud search of number of names of countries coming up, UK, you won't find them. So I think this is a good principle to follow if you want to take a more medium-term view on how things pan out.
Yeah, and I think it's the premise that I can trust the price right now. Can I trust fundamentals in those markets, given we are headed into likely a global slowdown?
Definitely. I mean, let's start with the U.S., right? We don't know where earnings will settle, where the steady state PE ratios, for example, of equities have to be. This shock didn't happen in a vacuum. U.S. has been pulling capital from the rest of the world at least since the GFC. So the share of U.S., for example, in MSCI World peaked above 70%. The 25-year average is around 57, 58%. So there is a lot of excess capital sitting there. And within U.S., you have obviously mega caps, so multinationals. So we have to start thinking about, in a deglobalized world, is this multinational exposure the best thing in a world which is deglobalizing? So I think this will take time, but this is a big themes which are starting to, emerge from this April, which never ends.
Never-ending month of April. Salman, just like your thoughts, what in your mind is steady state when it comes to tariffs? What is the end game for the tariff conflict, and where do you see the levies actually ending up?
So our baseline case is that U.S. effective tariff rate steadies at around 15 to 18%. Which is obviously significantly much higher than where we started off. It was around 2.2% at the end of December. But with meaningful differences on sectors, we are already clearly seeing some, method appearing there. And then, of course, a lot of different rates across countries and regions as well. But the current rates are unsustainable. It's very painful. We can see that both for if you home in on U.S. and China, it's very painful for U.S. It's very painful for China as well. So I think we would expect some kind of de-escalation, but this is not going back to December 2024 world by any means.
What's your sense of how resilient the Chinese economy is looking? Because not just from the first quarter, but more recently, some of these industrial profits numbers are also showing that, maybe they don't have to bring out the big guns as far as stimulus is concerned so soon. Maybe they're biding their time, keeping the powder dry. What is your sense of the state of play for China?
So I think right now we are in this difficult position because a lot of data we are seeing right now is rear view data. Obviously, the trade war itself got triggered early April, so we have to start thinking about how this pans out, how long it will last. So to your point, I think there is a wait-and-see approach, which makes sense because from China's perspective, they don't know yet where this final, tariff rate will settle, under which sectors. There's a lot of negotiation to happen as well. So that uncertainty means that there is obviously reasoning to hold that dry powder back because, fiscal, debt, overall debt ratios are very high themselves. So I think there is value in waiting to learn more as we go along, because there's also some indication that China wants to play the long game, if you will. So it's going to be, I think, they want to slow it down. At least that's our sense. But let's see how it pans out in the next coming days.
Yeah, they've given each other exemptions actually that that have largely gone unnoticed. So I think important that you mentioned we should assume that the market cap of U.S. equities, as the world may have topped out. Can I make the same assumption in China that reverts back higher historically because markets have de-risked from out of Chinese equities, right? And can I basically expect a reverse of that to the point you were making?
I think we are expecting that, but I think what is different this time around is that different investors geographically, I believe, will have a different risk assessment of China. I think that's probably
because of what?
Because of, I think, geopolitical and geoeconomic dimensions. So so I think Asia investors, I believe, need to diversify, and they will. I believe. I think, but what we are seeing is also U.S. investors still thinking about their domestic home bias. So home bias may become a dominant theme, which is basically slowing, which is, I think, is a consequence of this deglobalization. I think we go back to basics, right? If you damage trade relationships, then you're also damaging capital relationships, right? They don't happen in a vacuum. So home bias, I think, means that I do expect capital to go back to China, but more from the surrounding orbit rather than far away.
One group of assets that was largely, let's say, agnostic of the home bias is U.S. Treasuries. They always had a special place. Yes. What is the home bias of safe haven? What does that mean as far as income and what used to be in U.S. Treasuries? What does that mean for people who are looking to diversify away?
So, David,
the alternative.
David, that's the mammoth in the room right now. What is your safe haven right now? Obviously, gold has played a very important role in this whole, it has been going on for a while. It's not like latest trade war that gold has done well. It's been happening for a while as central banks have been buying, and then the market started started putting focus on that. And I think that's where I think the next few months are going to be critical, which is that are the underlying foundations of U.S. Treasury market shaken? How will the Treasury market deal with more tax cuts and still wide fiscal deficit in the U.S. as growth slows down? And the pressure on the Fed, right? And, so I think all those things are going to combine. But I think the initial thoughts obviously it's a huge question, but the initial thoughts we are having is that it will really depend on, where you are sitting. So your safe haven in Europe may be euro-denominated assets. In Asia, it may start to become CNY-denominated assets, and obviously the U.S. For the U.S. bloc. CNY has been very stable versus the dollar.
That's right.
Right. It's a very powerful signal, despite the fact that obviously, in principle, this is a significant hit potential to China exports. But I think that stability, sends a message out.
When you talk about this stability, Salman, they are also trying to do everything they can, I think, domestically to kind of provide some form of support. There's an employment briefing. Maybe we get some lines out of that in the next half hour or so. What is your sense of what the focus now for Chinese authorities needs to be?
I think it needs to be, in terms of where it needs to be, I think it's very clear, domestic demand. So I think we have to think about why did this situation arise. The underlying force behind that is that U.S. consumer, it's around 30% of world consumption. China's share of world consumption is around 12%. Europe is around 15%. So Europe and China combined cannot compete with the U.S. Consumer, the might of the U.S. consumer, which is being leveraged right now. So I think the focus long-term has to be, and structurally has to be, domestic demand. Otherwise, the dependency on U.S. stays.
Salman, thank you so much. Fantastic. Nice to see you. Salman Ahmed there, Global Head of Macro and Strategic Asset Allocation at Fidelity International. Right, just really on that last note that we ended on there, the big take is, in fact, on the U.S. dollar today as investors prepare for more potential pain. You can check that out on your Bloomberg terminals for you. And a big take also on the internet, Bloomberg.com. Plenty more ahead. This is The China Show. Good morning.
I want him to stop shooting, sit down, and sign a deal. And we have the confines of a deal, I believe. And I want him to sign it and be done with it and just go back to life.
President Trump speaking about his Russian counterpart, Vladimir Putin, and this renewed call for a deal comes after Trump met with Ukrainian President Volodymyr Zelenskiy on Saturday at the Vatican. For more, we're joined by Bloomberg senior editor Derek Wallbang. So, Derek, first off, I mean, it's quite remarkable, the optics of the meeting between Volodymyr Zelenskiy and Trump, because we all know what happened the last time they met. Talk to us about the significance of this. Does this move the needle towards any form of lasting peace?
Yeah, well, it was really a stark photo at the Vatican, right? There was 2 chairs lined up in an empty area of the Vatican. One was in Donald Trump, one was Vladimir Zelensky. And they sat there and talked about whatever they talked about. Nobody else is in earshot. What has come out since then is that Donald Trump has, how would I say, he has had a different tone on the Ukraine-Russia situation. I've seen a lot more criticism of Putin than we have seen previously. And I think that all of that's a little bit notable. Now, Trump is saying that they are closer to a potential agreement than some of his advisors have been. And let's be really clear, the outlines of some of the territorial concessions Ukraine would need to make, as J.D. Vance was talking about, are way more tilted towards Ukrainian sacrifices than Russian sacrifices. So there's a lot of work to do here. But it is notable the shift in tone that Trump came away with from this meeting. And I think details when they emerge are going to be really, really interesting. But let's look at that tonal shift for now.
What about how they are engaging with Russia? I mean, you alluded to some of this, but what more are we seeing in terms of that tonal shift?
Well, Stephen Witkoff has met with Vladimir Putin. Again, we're still waiting to see quite all of the details out of that, but that sort of shuttle diplomacy has continued to go. I think the real key is going to be when Trump and Putin maybe meet in person. That has been long speculated. There's a possibility that that could happen maybe on an upcoming Middle Eastern trip. Trump has said he wants to go to Saudi Arabia at some point in the not too distant future. So those would be some things I would be looking for there. And that's maybe the venue where you get some of that stuff done if it's going to happen. But let's be clear, Trump and his aides and his senior officials have been saying it is time to go now. It is time for a deal now. And it's going to be important if they get to the deal, sure, but if they don't get to the deal, who does Trump see as responsible for not getting there? That could help give us a shade of what the U.S. involvement in Ukraine is going to be going forward.
Increasing urgency towards some form of a deal. Our Bloomberg senior editor, Derek Wallbank, for us there. Thanks so much. And here are some of the other major political stories we're following. China has declared sovereignty over an uninhabited reef in the South China Sea. State broadcaster CCTV released images of 4 officers holding the Chinese flag on Saturday, standing on the disputed reef. The Philippines said on Sunday it had landed on 3 sandbanks in the area, releasing an image of officers holding up their own national flag. The 2 countries have overlapping claims over a series of reefs and small islands in the waterway. A flurry of new polls suggests U.S. voter discontent with President Trump's economic plan is damaging his popularity as he closes in on 100 days back in the White House. A CNN poll Sunday found 39% of Americans approve of how Trump has steered the economy. An NBC poll also showed only 39% of respondents agreed with his tariffs rollout. The main opposition party in South Korea has chosen former leader Lee Jae-myung as its presidential candidate. Lee won the primary on Sunday and will represent the Democratic Party in the vote on June 3rd. He's a frontrunner in the presidential race, leading in most opinion polls after spearheading the impeachment campaign against Yoon Suk-yeol. Plenty more ahead. This is Bloomberg. Here are some of the big corporate stories we're following. Bloomberg has learned that Elon Musk's XAI Holdings is in talks with investors to raise about $20 billion in funding. If completed, the deal would be the second largest roundup funding for startups of all time, according to PitchBook. Sources say the transaction would value XAI at more than $120 billion. The new funding could be used to pay down debt. DoorDash is offering to buy UK-based Deliveroo for $3.6 billion. A filing with the London Stock Exchange shows DoorDash proposing a cash offer for Deliveroo shares at $2.40 apiece. DoorDash owns 2/3 of the restaurant delivery market in the US, and a deal would help it to expand into the UK and cities in Europe. Dave?
Right, just a look at markets and some individual stock movers we're tracking here. Bright Smart Securities here on my right, as you can see, massive move up, 34. If you think that's up, it was up much, much higher earlier on, up as much as 61%. Takeover deal coming out of ads. This is a company, of course, that is a retail broker. The transaction was $362 million. That's dollars. Cash consideration there of about 2.8 billion. That's Hong Kong dollars, of course, there. So joint announcement there following this share purchase agreement between the two. 408 right now is where you are on BrightSmart. Right, we're looking at tourism-related stocks on your screens. Two separate stories. One is, of course, we're going into let's call it a truncated week here in Hong Kong. You have a holiday, which I believe is on Thursday. And then you have another holiday, which is on Monday next week, which I believe is Buddha's birthday on Monday next week. But in any case, of course, we are expecting tourism flows. And if you haven't taken your leave off yet, just take it. And you get a really nice long holiday. Not for us, though, but that's to be expected. That's number one. Number two is you have some numbers coming through there out of the officials. The other one is, as far as if you're a foreign tourist, the tax rebate policy in China as it pertains to the amount of money that you could then be eligible for a rebate for has actually increased down. And we're looking at now 20,000 renminbi maximum rebate amount for cash claims will be increased to that amount. That's according to a statement there. And yeah, going into the next hour of the China show, we're looking at declines, just about modest declines there, just about across most of the major benchmarks. Stay tuned, of course, for the very, two things. We have a big interview coming up in the next hour. Plus, we have, of course, the press briefing that is set to take place on employment, Avril.
Yeah, we'll be speaking exclusively with the AmCham China president about the latest report on how U.S. businesses are navigating the trade tensions. Keep it here with us. This is Bloomberg. Welcome back to the China Show. Here's a look at the Hang Seng about half an hour into the session. We're seeing it turning tail from the early goings, about 0.5% down versus gains of about as much at the start of trade. And of course, the key thing we're watching today, that briefing from Chinese authorities maybe gives us more details on what they are thinking when it comes to the employment picture in the country. On top of that, some of those developments as far as Huawei is concerned. Is this another sort of deep-seek moment? Although some of our colleagues have already pointed out that when it comes to the Chinese chip giant, some of these developments are really par for the course. Keeping an eye as well, of course, David, on any possible de-escalation of the conflict between the U.S. and China as far as tariffs are concerned.
Yeah, in fact, we might actually get more than, well, maybe at the very least, we might get anecdotal commentary on that, but maybe at best, even more examples, because the AmCham, of course, is joining us in a few minutes, and they have actually also talked about how they might actually be seeing across some of their members some signs of tariff exemptions in some cases. Right, now, as Avril was just pointing that out, right, so we're looking at really a fairly uneventful market Monday so far. It's mixed on price, mostly to the upside, though, mild bounce. We're looking at volumes really on the very lighter side of things right now, about 20 to 25% lighter than usual. Gold is pulling back as well, back below the 3,300 level. You're getting Brent, though, pulling back a little bit as well, following what really has been just a very difficult time here for global oil prices, which I guess is a dividend for the world if you think about it as well. Right. Now we are now just looking at, I believe we have some live pictures coming through from Beijing, this cross-department, cross-ministry briefing taking place. I don't have the full list. Min Lo will be joining us to tell us what the long list of ministries coming through there as well. And just to mention, the Ministry of Human Resources, I believe, as far as I can remember, is part of this, and that really goes into what they probably will talk about, ensuring employment. Just to get you guys updated as well on the latest growth projections coming through out of mainland China, out of private economists on mainland China's economy. And yeah, you're getting more downgrades coming through here as well. And as you can see, we now are firmly within the low fours across most of the consensus right now coming through from the street right now. So in fact, yes, we are looking at this briefing taking place focusing on policies to stabilize employment, promote what they call high-quality development. As follows, in case you missed it on Friday, the Politburo pledging emergency plans in the event that they are needed to buffer against external shocks. Let's bring in Min Milo, our China correspondent here, just to give us some more context on this ongoing briefing in Beijing.
Yes, you can actually see the people attending the briefing. They're all at a vice ministerial level, which is always the first clue as to whether we will get any market-moving information. And also the timing of this, given it follows straight after the Politburo meeting. Any big policy announcements should be from that Politburo meeting. Today should be about the specifics, the implementation of some of these policies. So when it comes to supporting employment, we know the Politburo had talked about creating this job stabilization fund, especially for companies that are heavily impacted by tariffs. Also, measures to support the incomes of those from the lower and middle income households, continuing those efforts to carry out poverty alleviation and rural revitalization campaigns. And then when it comes to the longer term focus, it's still on AI, right? And PBOC is there, which means that maybe we could perhaps hear about maybe the creation of low-cost credit to support investment into certain strategic sectors. We know that the Politburo mentioned the creation of this tech board in the bond market, which could help provide another source of financing for companies. And also other measures, including protecting people's livelihoods, relending facilities for the elder care, and expanding the equipment upgrading program. So this is something that I want to look out for, whether they will announce more product categories that would qualify for some of these subsidies.
Right, and this is against the backdrop of, this inward-focused exercise is against the backdrop of the external environment. What do we know, what's the latest on tariffs?
Well,
we have a latest.
Nothing really changed. Well, President Trump gave more sound bites. Again, he says that he thinks that China will want a deal soon because obviously trade has been falling off, and at some point China will want a deal, and he appears to be quite confident about it. He also says the U.S. is not going to lower tariffs unilaterally without getting, quote, something substantial from China. And when pressed about what that means, he says he wants China to open up its market, but then he qualifies that he's not going to ask for that in a trade deal because he doesn't think China will offer that. So a little bit of mixed messaging here. And meanwhile, bear in mind that China had actually taken steps to open up some of its markets, especially when it comes to the healthcare, telecommunications, tourism sector. That was a specific, very consistent message that China repeatedly said in its state media pieces that they were committed to opening up. But still, things are still in a limbo. Meanwhile, companies like Shein are already passing on the cost of these tariffs to consumers by raising prices as much as 50% when it comes to beauty and healthcare products, just about 8% or so when it comes to women's clothing. But already you're feeling the impact. These companies can't wait for the deal to happen.
Min, amid the rivalry, suddenly it's been about tech. AI has been a focus for China as well. What sort of policy support has the government been signaling?
Yeah, this came out of a speech that President Xi gave in a study session for the Chinese Communist Party Central Committee on Friday, and he was earmarking AI as this long-term development goal, calling for comprehensive policy support, whether it's in the form of fiscal and tax policy, government procurement policy, IP protection, and the like, and really emphasizing that China needs to overcome some of the challenges, especially when it comes to creating its own core technologies such as high-end chips or foundational software. He also called for education, AI education across all educational levels to create this pipeline of talent for the future of the AI sector, and also said that AI is essentially a global public good, and so there needs to be international collaboration, especially with the global south, to bridge that AI divide across the world. But meanwhile, when it comes to the U.S., well, that country wasn't mentioned specifically. It's clear through the state media pieces that the priority is really about hedging against these decoupling risks and ensuring that China is independent in this strategic sector.
Min, thank you so much. Min Lo, a China correspondent there with the latest on tariffs and some of the domestic-oriented policies, which actually we might hear more about in the next few minutes with the ongoing briefing taking place in Beijing. In the meantime, though, the American Chamber of Commerce in China, the annual business environment report has found that 1 in 5 companies surveyed among their members here no longer prioritize China as an investment destination. And the Chamber says that the percentage has actually doubled from pre-pandemic levels. The document also finds that the worsening, and this should not come as any surprise here, the worsening relationship between the two sides remains the top challenge for many years in a row. And I think it's 5th year in a row. Joining us exclusively to discuss the environment is Michael Hart, AmCham China president, who joins us right now. Michael, good morning, and again, thank you for taking the time. I guess let me start by asking you something very simple. How are you guys coping?
Well, good morning. It certainly has been a couple of busy weeks since the original tariff announcements on April 2nd, which, of course, that was not the first time that China got hit with tariffs, but the 145% from the U.S. and then the 125% from China has, of course, shocked the system. Companies are trying to figure out how they are impacted by the tariffs in both directions. And then, as you've been discussing, there have now been some exemptions in both places. And so companies are scrambling to try to see, can they get their products added to exemptions? And I'm speaking specifically here, exemptions to bring products into China that are exempt from China's 125% tariffs. We have seen, officially the government hasn't said there are any exemptions, but there are lists circulating, and companies have reported that they're getting some exemptions, primarily in IT, in healthcare, and now in aviation.
Well, which I guess is really a good thing. It is certainly, Michael, a sign of de-escalation, I think, if you want to phrase it that way. What about just to ask you as well, the other side to that, have any of your members, and we know about the Boeing story, of course, have any of your members experienced some of their products then being turned away?
So more than being turned away, there were a lot of shipments stacking up at China Customs, where China Customs was trying to figure out how to deal with certain products. And so this exemption list, we believe the first part was to help China Customs get unstuck, to say, we've got things backing up here. What do we do? And it's been very interesting, the discussions that we've had for the last couple of weeks with different Chinese government entities. They've had very specific questions. So, for example, they have said, what kind of products, if they stop coming into China, would halt your operations, right? So China is very keen to make sure that their economy continues to operate. So they've said, what products do you have where there's no replacement that you need to bring in? That's one. And number two, what are the actual codes? So very clearly, they've been collecting information specific with tariff codes, which shows you pretty quickly that's going to go to China tariffs and open up the system. And so, a number of companies have now been advocating, hey, can we get our products added to the exemption list as well? I think officially there has been no de-escalation, but to your point, the way the Chinese government is making exemptions, clearly they don't want their own economy to be harmed by the tariffs that they lay on, but they are also clearly looking for what are substitutes for U.S. products, and they're pretty serious about this tariff war with the U.S.
Michael, in your conversations with some of these businesses, do they see a sort of market put in shaping Trump administration's policies?
Yeah, I mean, of course, there have been many of our member companies are advocating in Washington, D.C., and my group will be going there in a couple of weeks to make sure we understand in Washington, D.C., how they're looking at the China relationship. I mean, I would start by saying, I represent the American Chamber of Commerce in China. Our companies have been here for years. We are a believer in the win-win. We believe that the U.S. and China both do well from trade. We stress the importance of this bilateral relationship. If China needs goods and services, we want them to be sold by American companies. And so we very much want to make sure that, anything other than national security concerns does not stop trade between the two nations. And so we certainly share our reports with Washington, D.C. As you noted earlier this year, we had our business climate survey, which came out. And then last week, our white paper, which is 600 pages in 2 languages. And so, we've been advocating for well over 25 years about we want to trade with China. We tell China where and when we think the trade isn't fair. We want to make sure that U.S. companies get a fair shake. By and large, we think that the trade is good. There certainly continue to be restrictions on U.S. goods coming into China, which is why we use these policy documents to advocate to the Chinese government directly.
As you alluded to, AmCham has long been advocating opening up of businesses in China towards, the foreign investment community. What are some of the things amid all this that you think they are getting right, and what more can be done?
So earlier this year, I attended what's called the CDF, the China Development Forum in March, which attracts global CEOs and brings out some Chinese leaders for the Chinese leaders to explain how they're going to drive the economy. One of the positive things that we heard this year, almost every Chinese leader said China is now focused on consumer growth. Of course, we've been advocating this for decades. There's concern that China wants to sell to the world but not consume. So it was good that we heard that China intends to consume. We also heard some things then that China is preparing to, for example, reduce government debt to give it more flexibility. So this is also good. We continue to hear that FDI is important, foreign direct investment is welcome in China, but we continue to highlight to the government where we feel that U.S. companies or foreign companies are being excluded. So the good news from the Chinese government is the Chinese economy looks like it's going to grow, looks like consumer demand is something the government's going to drive. But we're also concerned about, China also wants to be able to produce all the key items that they need for themselves, which sounds a little bit like we're being edged out of the market. And of course, in this latest tariff spat, the concern is that China, which controls a lot of the refining of, critical minerals, that they may be reducing those exports to the U.S., which will also, cause chaos in some of those supply chains.
And Michael, in which specific sectors, maybe just to also focus on things that have remained largely business as usual, where are things improving?
So one of the groups of companies, U.S. companies, that haven't seen much impact are those that have their supply chains in China. So, for example, people who produce here for the Chinese market, whether that be retail, whether that be IT or medical devices. In some cases, U.S. companies have already localized their supply chains, at least for the China market. So they produce things in China for the China market. Those have not been impacted. Anybody who brings in goods 100% to China, imports the finished product, they absolutely have been hammered unless they've been given an exemption. One of the interesting things that came out of discussions for the last couple of weeks was non-U.S. companies, so other foreign companies, Europeans, Japanese, et cetera, who say to China, hey, listen, when we produce in China, we have inputs that come from the United States, which are also being caught up in these tariffs. And those are areas that I think China did not expect. I think China did expect some tariffs from President Trump. I don't think that they expected them at this level. And so, of course, this has been a shock to everybody in the system, and we've been spending weeks now to try to figure out who's been hit, how hard, and how we can adapt.
Yeah, Michael, help us out as well there, because we're also grappling with, how quickly and frequent the headlines really change here. So you mentioned earlier on, in a couple of weeks, you'll be headed, of course, you or your members will be headed to Washington. Give us a sense of what your top asks would be on that trip.
So one of the most important things, and we do every year, we have what we call a door knock, where we go and meet members of the administration, members of Congress, and then think tanks who influence China policy. The most important thing right now is who is running China policy. Of course, under the Biden administration, we know that Secretary Yellen, Secretary Raimondo, also under Environment Secretary Kerry and Podesta, each of these groups had ongoing regular dialogues with China. And the Chinese were also sending folks to Washington, D.C. So the U.S. and China were communicating at many levels, and so it was very easy to pass messages back and forth. Of course, when the U.S. has a new administration, all of those cabinet secretaries change, and there has been an interruption in those regular dialogues. And so the most important question will be, who's driving China policy? Presumably, if it's a trade negotiation, that would be USTR. They were more quiet in the last administration, but we want to make sure that we are giving as much feedback to the U.S. government as possible so they can understand how U.S. companies are being impacted. We also want to make sure that people understand that the U.S. and China both benefit from trade with each other, and we don't want to take away any trade inadvertently that will hurt either economy. And so when we go to Washington, D.C., we're there certainly to share the experience of U.S. companies in China if anybody in Washington, D.C. wants to listen.
Yeah, well, hopefully it's open arms and open ears. Final question for you, Michael. Several— report, the white paper here. What did we miss? Tell us.
So I think, the most important message that we send to the Chinese government is, yes, you have opened the economy some, but there continue to be some areas that are very clearly restricted to U.S. companies. Financial services, digital services. If you think of the things that you can get, whether that be Facebook, Google, LinkedIn, none of those things are available here, Twitter, now X, as well. And it's interesting, when I have friends that visit who don't live here anymore, they talk about just how inconvenient it is to be in China, where China has created all of these competitors to U.S. digital services. So that's one. In terms of there's concern that U.S. firms are being squeezed out in terms of government procurement, and so that's an area we continue to advocate. If you think about, almost every hospital in China is controlled by the government in the sense of it's a regional hospital, and so we want to make sure that U.S. medical products and devices have equal access when selling into those systems. And so China has made a lot of progress. China continues to be an important market. We want to make sure that there's more access for U.S. companies so that U.S.-China is a win-win.
Michael, thank you so much, and we appreciate the time. Let's talk again after the trip, maybe, and we'd love to hear an update from you. Michael Hart, the president of the American Chamber of Commerce in China for us. Right, as that conversation was taking place, this ongoing briefing in Beijing is also taking place. And, we have some interesting headlines coming through. Let me start things off here with lines coming out of Salman, PBOC official. They're talking about how, well, number one, that the exchange rate has remained fairly stable. In fact, they did give, let me just look at that specific level that they've outlined here. I think they've talked about it's stabilized at the 7.3%, 7.3 handle. Now, just a caveat, I'm not exactly sure whether or not that is context into an observation or whether or not that's intention. That's an important distinction to be made. Anyway, we'll get you more updates coming through as well, coming out of this briefing taking place. Plenty more ahead here on The China Show. Good morning. Right, have a look at automakers. Only one name in focus here, Toyota. 5.3% are reporting that the company might be looking to buy out. Question mark. Toyota Industries, quite a hefty premium over the price on Friday. In fact, let's bring in Reed Stevenson, I believe, who joins us right now to talk us through what we know so far about the deal. Reed, why don't we start with the basics here?
Sure, happy to do that. If you recall, Toyota Industries is the original Toyota company. It was the one that made looms more than 100 years ago, and it birthed Toyota Motor, the company we know today as the world's #1 car maker. And Toyota Industries still makes parts. They actually are the world's largest maker of forklifts. And also looms, even to this day. And effectively what's happening is, Akio Toyoda, the great-grandson of the founder of Toyota Industries and the grandson of the founder of Toyota Motor, is looking to take Toyota Industries private. Now, what's the motivation here? Essentially, if you look at the numbers and the stakeholdings in between the Toyota Group companies, if he takes Toyota Industries private using his own family's money as well as financing from Japan's biggest mega banks, he could effectively increase his economic interest in Toyota Motor, which would be a big deal. The Toyota family does exert a lot of influence over the company as it is, but to a certain extent that influence is never matched by the stakeholding in Toyota Motor and the rest of the group. This would go a certain amount toward kind of bringing that in line, but obviously it does start to raise some governance questions.
Well, Reed, that gets into really, and I think the shares are, we're struggling to still see, an equilibrium between bid and ask. It's looking like the stock's going to be forced to match at the close here, limit up, and I guess that's our starting point for tomorrow. Help us understand the risks to that deal and the reasons why this might not actually go through.
Sure. So, the limit up is obviously they are offering quite a hefty premium. Essentially, the big question is, are institutional investors going to go along with that? Possibly, possibly not. The forces at play here is that, more broadly, Japan is moving toward greater corporate governance, more accountability, the unwinding of cross-shareholdings and parent-child relationships between group companies. And Toyota itself has taken some significant steps in this direction. For example, it changes board structure earlier this year to have a majority of the directors be independent. But going in the kind of opposite direction is this potential deal, and essentially it's going to be at what price?
Yeah, well, what we know so far is 60 trillion, but yeah, I mean, that could change. Reed, fantastic. Thank you so much. Reed Stevenson in Beijing for us, our senior editor there. Plenty more ahead. Welcome back. We're looking at nuclear stocks, reaction to new reactors. Yep, 10 new reactors approved in China. Were high, coming off a little bit as far as that's concerned, but policy support coming through in these markets. AI stocks also on policy pronouncements. We're seeing some decent gains there as well. We'll take you straight back right now to this live briefing taking place in Beijing, multi-department. You have the PBOC involved, you have the NDRC, among others. And, well, let me start things off by just the latest commentary coming through here out of the NDRC. China is confident, not that we should be expecting anything different anyway, is confident to reaching the economic target this year. I mean, on that very note, when have we heard from any economic official globally talking about how they're not confident in reaching any target? We'll see on the other side. No, but I guess on a more serious note here, reiterating that their commitment to being able to reach that consumption, that growth target. We're also looking at, again, a swing at the U.S., talking about how it's been bullying. We're looking at the reciprocal tariffs are a typical unilateral bullying act that's according there to them as well. In terms of the PBOC and the exchange rate, right? And by the way, important context here. We had the Politburo meeting on Friday. We had some commentary coming through out of PBOC Governor Pan Gongshun. And really discussing what markets have been waiting for. Do we get that triple R cut soon, in time, is how they phrase it. For the current level, for the time being at least, 7.3 is the level that they have observed to be a level that's the currency is stabilized at. For one, it will come in time. For now, it seems that currency stability, based on the commentary coming through, is the way to go currently. As far as other things are concerned, I think the context here is more than the macro, is really ensuring the level of stability in the employment situation. Of course, they have underscored many times that consumption is going to be key, if not the absolute focus of policy this year. And of course, employment goes really part and parcel to that very start. We'll leave that there for now, and we'll bring you more headlines coming through once we do get more coming through there out of the briefing taking place in Beijing out of Chinese economic officials. In the meantime, let's get more context on markets right now, and let's bring in our MLive strategist, Mark Cranfield, joining us out of Singapore today. Mark, the whole macro question, to what extent can the dollar fall? What currencies might likely be at the forefront of dollar weakness? What comes to mind? What specific measures should markets be looking at this week as we try and figure out how low we can get on the dollar?
I think it's still the euro and the yen are still the leaders from that point of view. And if you listen to what happened last week, now the Fed has gone into a blackout period. But the last thing that we heard from a Fed official was that they could be open to the possibility of lowering interest rates in June. Now, that was only one speaker. It doesn't represent the whole Federal Reserve, but it's the last thing that traders heard before we went into the blackout period. That's why it's carrying more weight than you might expect it to otherwise do so. Nobody's expecting the Federal Reserve to change interest rates this week, but clearly it looks as though there are live meetings ahead, and traders are latching onto that. And that's partly why the US yield curve is steepening, driven by short-term, the 2-year rates in particular are falling more quickly. Now, we've seen, as that nice chart on the screen shows at the moment, dollar yen's path in linking to 2-year treasury yields has been pretty good over the past several months. There's been one or two little blips particularly in the past few weeks when we had a general meltdown in US assets. But basically, dollar yen tracks the path of short-term interest rates. And if US interest rates are going to continue to head lower, that's obviously a positive for the yen. And you can also feed that into expectations for the euro as well. On top of that, we have a Bank of Japan meeting this week. Again, Bank of Japan not expected to change anything, but people will be thinking that it's an opportunity for a hawkish hold from the Bank of Japan. Now, they have a bit of a window here. They've just had inflation. Tokyo inflation last week was very hot, way above expectations. Bank of Japan are trying to convince everybody that their inflation targets are going to be met. Well, they surely will be after an inflation number like that. They probably don't want to wait until July, because that's when there's upper house elections in Japan. So June is going to quite likely to be a live meeting for the Bank of Japan. Now, they are not like other central banks. They don't need the market to price in an interest rate cut or an interest rate hike. That's not how they play the game. People know that the Bank of Japan, all that really matters is the last 7 to 10 days or so before a Bank of Japan meeting, you start to get the leaks in the Japanese media when they're confident that they can make a change, and then the change in policy comes at that meeting. So even if the market is not expecting an interest rate hike in June, we will look at very carefully for the nuances in the wordings from people like Governor Ueda. We'll look for the press and the media announcements, and we may well get, if the equity market is stable and generally conditions are okay in Japan, then June looks like a possibility for the next hike in Bank of Japan.
Mark, then can I trust that equity markets have, recovered, not completely, but certainly we've seen price moving up. I'm just working on a chart right now, which I hope to be able to just fancy out so I can show our viewers in a couple of minutes here, maybe later. But, effectively we've recovered to several, let's call it, technical levels here. Can I trust that the momentum for equity markets will be towards the upside this week than otherwise?
You're probably going to get some kind of a divergence here because the US markets led the bounce last week, but there might be a lot more caution coming into the US. But there, as Bloomberg is running stories saying that fund managers are clearly positioning into some other parts of the world. Just because as long as US markets don't go down heavily, we may well see a repeat of some of the instances we've seen this year where money starts to shift to Europe, to Japan, to other parts of Asia, and they can hold up reasonably well, even if there is weakness in US markets. The way in which the S&P 500 rebounded, it really looks like a bit of a textbook knee-jerk response that really has reached a kind of a ceiling already. And it wouldn't be at all surprising if we see weakness in US equities this week. It doesn't necessarily mean it will translate into global weakness, providing it's a relatively contained move. Of course, if US markets drop 5%, it's pretty hard for everyone to ignore something like that. But that doesn't look as though that's on the cards, particularly when you've got a Fed meeting coming this week, when the nuances are that people are beginning to think that there will be something of a slightly dovish tilt to the statement or to the press conference coming out of the Fed. So expectations are that the Fed will certainly steer people towards thinking that a rate cut could be coming in the next couple of meetings.
Mark, thank you. Mark Cranfield in Singapore for us, their MLive strategist. Let's discuss the other question that markets are grappling with, right? Is the U.S. exceptionalism story one and done or done? So you have Nouriel Roubini says that concept will remain despite, of course, President Trump's trade and immigration policies. Now, speaking with Bloomberg, the Roubini Macro Associates chairman and also CEO also gave his outlook for the dollar moving forward.
I've been arguing for weeks now that tech trumps tariff because there is a revolution coming from AI and an industry of the future. It's AI, robotic, automation, semiconductor, fintech, defense tech, green tech, ag tech, you name it, space exploration, quantum. These things are going to increase U.S. Potential growth from the current 2% to a level I expect by the end of this decade closer to 4%. So 200 basis points increase in productivity growth. Instead, even in the worst scenario on trade and restriction to migration, and we're going to de-escalate, the potential hit to potential growth could be maybe 50 basis points. So we have a ratio between 200 basis points up because of technology and negative 50 basis points is 4-1. So tech trumps tariffs. And therefore, the U.S.-American exceptionalism is going to remain in spite of bad trade policies, in spite of bad migration policies. So in that sense, I'm optimistic that not just in the short run, but also over the medium term, we're going to avoid a severe recession and U.S. is going to remain strong.
And that, so tech trumps tariffs, and then at the same time, like for AmCham, it was deregulation trumping tariffs as well at this point. What about the issues with the dollar and the back end of the curve? So higher yields and a weaker dollar, and if we move out of dollar as the reserve currency, even on the margin, how do you factor that in?
Well, regarding the dollar, there are different types of investors. There are those that are fixed income investors, foreign reserve asset managers, sovereign wealth funds who are in fixed income. Some of them are worried about the dollar because, of course, we have undermined the credibility of the U.S. dollar. But if I'm right that we're going to go from a 2 to 4% growth, in the U.S. there'll be a massive capex and investment boom. That's already occurring right now. It's Mach 7, hyperscalers, firms in the NASDAQ, but even non-tech firms, they have to have an AI strategy. And are they going to do less investment because of trade restriction? No way. So we have massive tailwinds, imply larger investment as a share of GDP, and capital inflows that are going to be FDI, greenfield and brownfield, and portfolio investment into the equity market. So the dollar can weaken because fixed income folks are nervous about us meddling with the reserve currency role of the dollar.
Nouriel Roubini there, speaking, of course, with our colleague Alex in the U.S. first, right? The U.S. exceptionalism, right? That's a very big topic. In fact, we just had the head of asset allocation at Fidelity coming through as well. And it's really a question that they have been talking to their clients about, right? And I basically asked them earlier on shows, they effectively, to what extent, like, what do we know? How far does the sort of stepping back from the U.S. dollar, U.S. assets, how far does that go? So he said there are lots of unknowns, but what's likely clear is that the share of market cap, global market cap, attributed to the U.S. likely topped out. And chances are this goes down, that it does go up. And might you be better used to take a moving average of this and just to figure out what the longer-term exposure is appropriate mandates to U.S. assets, right? That's the point number one, and I think they were just talking about that. Let's flip the chart, please, with Roubini and U.S. exceptionalism. But, I mean, is a U.S. market exposure really supposed to be at 50%? I think that's a bigger question. Right. The flip side to that is, from a tactical perspective, APAC stocks, as you can see, we're up about 1 point. Liberation Day, this is on price. We've actually now recovered back above some key moving averages, and we've also seen a pickup and recovery, not completely, but in more ways than one this week, going into a fresh trading week as far as momentum goes, right? So I'll leave the two charts for you guys to just ponder on as you try and figure out what this week will hold. And of course, if you're one of our Bloomberg subscribers, you can check out TV Go on your Bloomberg terminals for more on this. Less of me, hopefully. You can scroll back, all the way back. And yeah, just help you understand what the week holds in store. Plenty more ahead. You're watching The China Show. Right, welcome back. Big election week coming through. You have the Canadians will be electing a new government on Monday with Mark Carney, the Prime Minister. They're hoping to lead the Liberal Party to a fourth straight victory against the Conservatives. Now, David Gura takes a look at the state of the race.
Prime Minister Mark Carney, former governor of the Bank of Canada and the Bank of England, leads the Liberal Party into the election after taking office last month.
My government will put into action our plan to build a stronger economy, to create new trading relationships with reliable trading partners.
Carney's rival is Pierre Poilievre, the leader of the Conservative Party. A few months ago, Poilievre was riding high. Polls showed him heading for a landslide victory, potentially securing a two-thirds majority in the House of Commons. But things have changed. Since Carney entered the race, the political landscape in Canada has shifted. Poilievre's lead has evaporated, and both the New Democratic Party and Bloc Québécois have lost ground. If the Liberals don't win a majority, however, they'd need support from the NDP or Bloc Québécois. Complicating matters, U.S. President Donald Trump's aggressive trade policies, particularly new tariffs on Canada, are dominating discourse about the election. On top of that, Trump's suggestions Canada could become the 51st state in the U.S. have drawn more attention than domestic issues, and those comments have changed the political climate. Both Carney and Poilievre have taken a strong stance against Trump's provocative rhetoric and policies.
The president is betraying America's closest friend and attacking our economy, proving once again that Canada must end its era of overdependence and weakness.
For Canadians, this election is a referendum on their economic future. The outcome could determine how the country addresses these challenges and how it positions itself on the world stage.
There we go. And for Bloomberg clients, you can check out more on this. We have a full blog coming through around this time tomorrow, so stay tuned for that in about 24 hours from now. TLIV Go to get commentary and analysis on the major items on this week's agenda. Plenty more ahead. This is The China Show. Good morning. Right, welcome back. You're watching The China Show. President Trump's trade policies are, well, dramatically changing the landscape for Chinese car makers and companies developing AI-powered tech. But you have Chinese self-driving system developer Momenta, which works closely with the likes of Nvidia, told us why they are not too worried about restrictions on chip supply.
The restriction is mainly for clouding computing for training AI model, not for inference. And I think it's beneficial for US and China for the autonomous driving computing. No ban in both countries, and the likelihood is very low at first. And also in China, there's some autonomous driving chip provider we can collaborate. Yeah. We are hardware agnostic.
How are you impacted by rising protectionism as the world tries to move towards a more autonomous automobile future?
Yeah. Our current focus is still China market, and in the future, with our partner, probably we will go to other parts of the market like Europe, Asia, as our Middle East as our second step. Yeah. So currently the tariff protection have no impact to us because we are still in the first step, and no impact for our second step.
How important is the need for guardrails from a regulatory front? We do know that the Ministry of Industry and Information Technology is out with their concerns and their guidelines as far as the development of autonomous software and autonomous programs. They kind of want to put safety to the fore because of that Xiaomi SU7 crash that killed 3 people, which was on autopilot at the time. So obviously you have to comply with these new regulations from MIT, but how important are these safety concerns?
Yeah, it's very important. In our company, safety is always the top priority. Actually, we have a 10 years vision. It's called 10 years, save 1 million lives. Yeah, that's our vision. And also, I think safety is very important to the industry to have healthy growth. I think for the government, they should set up a very clear and high standard for safety so that the good company can grow fast and the bad technology or bad company were out of the market.
Do you think this new increased scrutiny from the government is going to slow the pace of progress towards eventual level 4? And is that necessary? Just a little bit of a pause?
I think in the long run, it will speed up.
What are your foreign partners? I mentioned Mercedes, I mentioned General Motors. What are they looking at from you as far as the local market? Or are they looking at taking this as well and applying it abroad?
It's a good question. Because of the benefit of the China market, the progress of our autonomous driving solution product in China, progress is quite fast. Many international OEM come to China, they bring their best team to China, and they develop the first mass production in China. And some of the global OEM, they want to reduce the investment and reuse the outcome of the investment for global market.
There we go. That was the CEO of Momenta speaking with Stephen Engel at just of course, as Steve was wrapping up there, his coverage of the Shanghai Auto Show, right? From that big event from last week into the big event for this week, which is Chinese bank earnings, and really to what extent will we see in those earnings the showing up of lower rates in China, right? And to that extent, we're getting, I guess, perhaps incrementally more guidance coming through here out of officials talking about how they will need to guide the banks to keep lending to exporters in difficulty. Point number one. Point number two, again, more commentary coming through here on the timely manner, without going into specific details here. Zolan, a PBOC official, China will be cutting the reserve ratio requirements and interest rates in a timely manner, flagging that it likely will be in your future. Whether that's in your immediate future is another thing, I guess, altogether. But that being said, we'll be maintaining ample liquidity in Chinese markets. And really, right, so if you're a credit issuer looking to where to issue your credit, certainly, your renminbi, local currency denominated credit, where you are with rates and substantially lower than in the dollar markets here offshore, point number one. But when you also look at, I guess, at a point of renminbi rates outside of mainland China, and we talked about how you have CNH HIBOR here touching a multi-year low last week, just indicative really of the point that they're underscoring there, that there is ample liquidity here in the system. Right, other things taking place as well here. This is a briefing that centers around job market stability, and we did get here commentary coming through out of the China Human Resources Ministry official a few minutes ago, the need to prioritize employment of college graduates, and they are confident in maintaining job market stability. All right, we'll table that for now, and we'll see whether or not we do get more commentary coming through out of Chinese officials. In the meantime, though, let's have a look at geopolitics here. The South China Sea. China has declared sovereignty over this uninhabited reef in that part of the world, setting the stage for an escalation of tensions with the Philippines over the disputed area. Cliff Venson is with us out of Manila to talk us through. Cliff, good morning, nice to have you. Get us up to speed here. What's the latest on that story?
So that's right, David. China State Television, CCTV, on Saturday reported that China Coast Guard implemented maritime control and exercised sovereign jurisdiction over Sandy Cay in the Spratly in mid-April. Now, the Philippines countered that claim on Sunday, saying its own military and Coast Guard personnel completed an operation there to reinforce its jurisdiction over that part of the South China Sea.
All right. What's the latest from Manila then? How are they reacting?
So the Philippine government officials said that it remains status quo there, and that there were no indications of occupation of Sandy Cay. One Philippine government official called the Chinese claim fake news. So note that this is a very strategic portion in the Spratly, because Sandy Cay is near a Philippine-controlled island in the South China Sea.
Okay, Cliff, we're looking at some live pictures too out of Manila right now. Yeah, but Cliff, sorry, just to interject here as well. I mean, it's an issue between the two countries. I can't help but think whether or not this will have an impact, ahead of midterm elections taking place in the discourse. Cliff, very quickly.
Yeah. So the National Security Council official actually raised questions about Beijing's motivation, asking why China is releasing this claim just 2 weeks ahead of the midterm elections.
Right, Cliff, thank you so much for the context there. Cliff Venson in Manila for us. We will see you all tomorrow here from the China Show.